Have you ever heard someone say, "The Fed is raising rates," and wondered what that means? Or maybe you've heard your parents or friends talking about interest rates going up and wondered how that could affect you. And today, we're going to talk about something that might sound big and complicated, but don't worry, we're going to break it down so it's easy to understand. Well, in this video, we're going to explain who the Federal Reserve is, what it means when they change interest rates, and how their decisions can affect your mortgage, whether you're buying a home, already have one, or thinking about refinancing. Let's get started. First, who is the Federal Reserve? The Federal Reserve, also called the Fed, is kind of like the boss of all the banks in the United States. They help make sure the economy stays healthy. One of the biggest tools they use is something called the federal funds rate. That's just a fancy way of saying the interest rate that banks use when they loan money to each other. Now, you might be thinking, what does that have to do with my mortgage? Great question. Even though the Fed doesn't set mortgage rates directly, when they raise or lower their rate, it can cause mortgage rates to go up or down too. Here's how it works in simple terms. Imagine you're riding a bike and the Fed is the person turning the gears. When they make it harder to pedal, by raising interest rates, it costs more to borrow money. When they make it easier to pedal, by lowering rates, it costs less. So if the Fed raises rates at the end of the year, like they sometimes do when the economy is growing fast or prices are going up, it could make borrowing more expensive. That means higher mortgage rates. Higher mortgage rates mean your monthly payment could be higher if you're getting a new loan or refinancing. Let's say you're buying a home and your loan is $300,000. If your interest rate is low, maybe 4%, your monthly payment might be around $1,400. But if rates go up to 7%, your payment could jump to nearly $2,000. That's a big difference. And it's all because of interest rates. Now, what happens if the Fed lowers rates? Lowering rates is like making it easier to ride that bike. It's cheaper to borrow money, so mortgage rates may drop too, making home loans more affordable. This can be a good time to buy a home or refinance the one you already have. But here's something really important. Mortgage rates don't always move exactly the same way as the Fed's rates. There are other things that can affect them too, like inflation, job reports, and what's happening in the world. So, why does the Fed make changes at the end of the year? The end of the year is when the Fed looks at how the economy has done over the past 12 months. They check if prices are rising too fast. That's called inflation, if people are spending money, and if enough jobs are being created. Based on what they see, they decide if they need to make borrowing money harder or easier. And guess what? Those decisions can trickle down to your wallet, especially if you're dealing with a mortgage. Let's do a quick recap. The Federal Reserve is like the money manager for the country. When they raise interest rates, mortgage rates can go up, and that means higher monthly payments. When they lower rates, mortgage rates might drop, and borrowing can become cheaper. The Fed often makes these decisions at the end of the year based on how the economy is doing. Mortgage rates don't follow the Fed exactly, but they often move in the same direction. So, what should you do? If you're thinking about buying a home, refinancing, or just want to understand how interest rates might affect you, it's a smart idea to stay informed about what the Fed is doing, and that's where we come in. We're here to help you understand your mortgage options and what these changes might mean for you. Every situation is different, so don't guess, get the facts. For more information, be sure to connect with us. We're here to help make mortgages simple and easy to understand.
Thanks for watching. Whether you're buying your first home or refinancing your existing home, Mortgage and Credit Pro is dedicated to providing you with the best in service and products. We are here to answer your questions and help you through the process. You can reach us online at www.mortgageandcreditpro.com. We look forward to working with you.